So thanks everyone for joining us today. We really appreciate it, and we're hopeful that we can give you some good information today. Some of you, I think, have joined us yesterday and today, and I think 102 is a really good build off of 101. I like 102 better in part just because it sort of takes those concepts and takes them to a little bit another level. So one thing I want to speak to right off the bat is, of course, we want to use the chat function today to have participation, and Mark and I thrive on participation. So as much as we can get that, we'd like to. I see that Louisa did send something in the chat and went to the panelists. And if you can, I would like it if you can change your chat function to go to everybody, so that not just the panel sees your chats in terms of when you're contributing to different questions, just because we want everybody to sort of participate and be a part of it if you can. If you have a question directly for the panel, which is just Mark and I, it sort of sounds weird to call us a panel, but that's fine. Then we would ask you can use that Q&A function. That'll go directly just to the host, and that stuff will stay there until we address them. And so we'll address those as we go through, or at a good stopping point. And Ash will kind of manage that for us today. You've already been exposed to the poll questions yesterday, probably for some of you, and already with these fun polls that Ashley created for us. So we'll be doing some of those throughout the day. Just to sort of get some feedback and get some interactivity going. But the main thing I want to stress is we want to hear from some folks through the chat function and otherwise as we go, because that is kind of what we thrive on. So I want to give Dana a shout out, because yesterday she was quite a prolific contributor, which we really appreciate. Absolutely. So yeah, I guess we can start the broadcast. But so my name's Craig Reed. I think most of you know, but there's a few that are just new today. So I'm a partner with Virtus Group in Regina, and I've been with the firm about 20 years or so, and work a lot with owner-managed clients. So a lot of folks that you guys would be related to, maybe I've helped through the years. And I'll maybe let you guys introduce yourselves today, so I don't steal any thunder. So go ahead, Mark.
Oh, me? Great.
Yeah.
Thanks, Greg. My name's Mark Steffen. I am a Vice President and Wealth Advisor with RBC Dominion Securities. I have been with RBC Dominion Securities for 23 years, but I have been in the investment and the insurance wealth planning world for 36 years now. So it is a passion of mine to help people with financial literacy, especially younger people getting a good start, starting on the right foot. We had the basics yesterday of 101. That's pretty rudimentary, but some important things. And hoping everyone that was on the call yesterday learned at least one new thing. And that's my big focus when I participate in things like this, is to learn one thing that I didn't know before, but more importantly than that, actually to implement it and to put it in action. And if we did that every time we participated in one of these things, it's amazing where we're going to be in a few years, because that's the whole thing. Many people go to these, they don't maybe, do that. They might learn it, but they don't implement it. And if you don't implement it, I could, you might argue the fact, did you really learn it? So that's me, and privileged to be here. Thank you so much. It's great working with Virtus Group. We've been doing this for a number of years. So thanks, Craig.
Thanks, Mark. Ashley, you want to give yourself a little more spiel than what I did yesterday?
It'll probably be a little less spiel.
Okay. All right.
I'm Ashley. I'm the marketing manager at Virtus Group, and I'm just basically here to supervise these guys and make sure everything runs smoothly, and ask questions if I have questions, and give you guys a little bit of a mix-up, I guess.
Oh, she's too humble to speak about her wakeboarding prowess today. That's okay. Those who were on the call yesterday are fully aware. So we'll get going with the slide here in a second. Just sharing the screen now. So I think we do, because we will have some new people in the session today. We're going to start with that same question that we had yesterday in terms of what stage of life are you in terms of, just so Mark and I have a little better sense of where you're at. Up to 15, 16, 17. Oh, respondents coming through in spades here, so that's good. Okay, so I'll just share the results with everybody. So similar to yesterday, sort of quite a few, a little bit that post-secondary and graduated, which makes sense. It's a little bit more advanced today. So that's perfect for today's session. That's wonderful. Mark, I'll turn it over to you to give us the big rundown here.
Awesome. Thanks, Greg. Yeah, and actually, you know what? That poll is very, very helpful because this you will find for looking at the people, like I say, we had 11% in high school and then everyone else beyond that. So there's lots of people on this call that are experiencing a number of these things that we're going to talk about here from a standpoint of product and strategy. And so we're going to hit, as we said yesterday, what it's designed to is just hit the highlights, plant some seeds, give you the information. You can ask some questions, we can expand on it, but we don't have, you know, a lot of time to expand, and it's just the way the presentation is designed. What we always encourage people is, because you're connected back through the Vertus team, that we're always happy to do a phone call or to do a one-on-one if someone wants to explore it further. That's certainly what I'm always open to doing. So just remember that, and hopefully don't get frustrated that we maybe don't dive too deep in this and we are restricted by time. So 102, if you give us the next slide, Craig, we're going to show the agenda. So here we go. So this is what we're going to get through today. For those of you that were on the call yesterday, we had a priority pyramid from a money sense standpoint. So, you know, cash flow. Are you spending less than you're making, or are you making less than you're spending, or more than you're spending is the big one. We talked about, are you paying off credit card debt? Are you managing to save money? That was the first three stages in that pyramid. Today, we're going to talk about financial planning. So how the products that you might look at factor into what things you should be doing first or considering as the base to your pyramid for a financial planning basis. We're going to hit the highlights of wills and powers of attorney, remembering that people, we don't think about those things, especially young people. As soon as you own property or you have family responsibilities, or even just like I said, you've got a significant other that you cohabitate with, you've got a spouse, once again, family, all of those things, people always begin to think about planning afterwards. But as soon as you own property or you have assets to worry about, you really have to put that planning in place. We're going to talk about something called dying intestate, which means dying without a will, and who makes the rules if that happens. We're going to give you just a little highlight on life insurance, something called living benefits. We're going to get into real estate and mortgages. So the bottom half gets more into the investment side of things, real estate and mortgages, investment strategies, pools of capital, and then the psychology of investing. So that tends to be where people really like to get to quickly. So bear with us as we take you through the planning stuff up front, and we'll go from there.
Yeah, so we'll just launch a poll now just to get us flavor of what people want to get, what they want to get out of today. I can assure everyone that today I finally figured out my keyboard, so we won't have the same glitches in that regard today. Okay, we've got about, most people have been able to, how to invest, Mark. So they want to really learn from you. That's perfect today. That's perfect.
Well, we're going to have to go fast on the first 4 items so we can talk way more about that. We'll do that. All right. Thanks, Craig. There we go. So for everyone, this is the priority pyramid from a financial planning standpoint. So for those of you that were on the call yesterday, if you remember, you've got to be making more money than you're spending. You've got to have eliminated your credit card debt in order to even get to the saving aspect of the pyramid. Once you're into the saving aspect of that pyramid, the bottom, we talk about 4 types of dollars. On the left-hand side, you see 4 types of dollars: protection dollars, savings and accumulation dollars, growth and diversification dollars, and speculation dollars. Some of the big errors that I see people make at a young age is they get into the speculation dollars far too quickly. Real quick story, when I was younger, I grew up working on the farm for my dad and my grandpa and my uncle who were farming. And he said, I'm going to pay you the same way. I'd have to pay a hired person, and I'm going to pay you that same rate. So way back then, I was earning a whopping $4 an hour. And it wasn't the easiest work in the world, but it was good pay for back in those days. And I made $400 one summer. And that was after I sort of had my spending money and whatnot. I was still a little too young to have a driver's license, but of course I drove the equipment there. But that $400 at the end of the summer, I asked my dad, I says, I made this money. I want to put it into something as an investment. And anyone want to take a crack at what my dad recommended I invest that $400 in? You can fire it in on the chat if you want. Anyone take a shot?
I don't even have an idea.
Oh, Kendall, that is a great guess. Really close, really, really close. Gold would have been a way better investment. He actually convinced me to buy an Olympic coin set in that year. So it came in a nice case and all that stuff. Does anyone want to guess at what that Olympic coin set is worth today? And I just got to tell you, that was, just to date myself, that was 43 years ago. Actually, 44 years ago is when it was. Anyone want to guess what it's worth today?
Is it worth the same as? Oh man,
it's worth exactly the same as that. Okay. Remember that story, everyone. That's a little bit, and I don't want to throw Hudson under the bus here. I don't know if he's on this one yesterday, but
he's not able to attend today. I know.
Okay, because he asked about Bitcoin yesterday, so that's why I got a little bit. I'm a little nervous when people say coins of any kind. So once again, that's what people do, though. They get into speculation dollars because they're looking for the big win all the time. But if you look at the bottom, it shows you the things that you should think about doing. Protection dollars, in other words, having your will in place, reducing debt, regular savings, having an emergency fund. Quick question. Does anyone know when people say have an emergency fund, how many months, there is a rule of thumb on that, how many months of income do they suggest you should have in an emergency fund?
3 months?
3 months?
Well, that's what I think, but I was going to wait for them, yeah.
Sure, 3.
There's Dana with a 3.
Jillian 6. So you know what? Absolutely, and it actually is from 3 to 6. There you go, Kendall, right on. So 3 to 6 is a suggested number. And when you think about that, for how much money you make, I mean, does anyone you know, or is anyone on the call, do you actually have 6 months worth of income just in cash reserve that if you need it, you can draw on it?
I'm ashamed to say I don't, Mark, but I've got access to credit. I've got access to credit, right?
Dana, good job. That's great.
Oh,
and
Dana, yeah.
Yeah. So now Craig made a good point. He said he has access to credit. And this is where one of the first real decisions you have to make is, do I have all of my available cash invested, either for the short term, medium term, or long term? Or do I have it sitting in cash earning nothing, because you don't get paid on cash nowadays in the bank, pure cash. Do I earn nothing and have access to it? So there is an argument out there to say, if you've got a good savings pattern, you're investing money and you're staying fully invested, that if you, in the short term, if you need a line of credit to access just to help you through that time, you might have to cash in a short-term investment, but you may pick up on doing better on your return on doing that. Once again, it comes down to one important discipline or word, it's discipline. If you're a very disciplined person, lots of people can manage that way. I manage that way myself. I like to stay fully invested, and if I need money in the short term, I use my line of credit, but I don't carry debt for very long. So everyone will find a different place where you're comfortable. There's no right or no wrong on that one, but once again, it's your discipline. And then types of insurance to have in place. People say, well, why would I buy insurance like right away? Most of you, if you have an employer and you have a benefits plan, you're provided life insurance. If you have responsibilities, life insurance is a simple thing. It is cash when needed. If someone passes away, all their future earning potential is really consolidated to that one amount of money. That's all that person will ever contribute going forward, given if they pass away. So that's why that bottom, the foundation to the priority pyramid from a financial planning perspective is about protection dollars. Next to that, savings and accumulation dollars. We're going to talk about those products. Tax-free savings accounts, registered education savings plans, RSPs, home ownership, fixed interest, mutual and segregated funds. We're going to talk about bonds and equities and paying down mortgage. We alluded to it yesterday, and Craig operates the mortgage calculator. We're really going to show you the impact of mortgage pay down and why it has a lot of merit. And then when we get to the top, we're not going to get into it in real detail. We'll answer some questions. We will talk about real estate, but we aren't going to get deep on the speculation dollars. On the right-hand side, as you see, if you need short-term dollars, towards the bottom, the more liquidity you want. So the easier they are converted to cash. Typically, you have less risk with those products, but you have lower return as well. As you move up the pyramid, your risk increases and your liquidity reduces. Like if you have a commercial building that you own, it's not always readily liquid. You can't just turn around and sell it in a day and say, oh, there's my cash. The issue is that your risk increases, and once again, so does your potential return. And I say potential because return doesn't always increase as you move up. There's a higher risk of loss than just what we'll talk about as we talk about investments with volatility. So we're going to talk about risk and volatility, meaning the same thing, but yet being very different. Right. Questions on the pyramid, anyone? That's where we're going. Craig, any add-ons?
I don't have any real add-ons there. No, it's we are going to go in a little bit of depth on TFSAs and RRSPs, which are really common products and really useful products. So we'll see that in a little bit here. Yeah.
Nice. Good.
I don't see any questions through the chat, so we'll move to the next slide. Eventually. Here we go.
All right. We're back to the twins, Lisa and Bart. Now we're going to talk about a product out there called a retirement savings plan. We often know it as a registered retirement savings plan, or RRSP. Once again, when we speak of an RRSP, it's registered. It means it's registered with the federal government. You are tracked by a social insurance number that you have to provide to open an RSP account. And what that means is the government then identifies that that product has a little umbrella over it, the way I like to talk about it, because you can invest in all the same things inside an RSP as you can if you're just saving the money outside of an RSP. And there's lots of confusion out there because people think an RSP is a specific product. It's not. It's the registration umbrella over the product. So if you buy a mutual fund and you just invest in it as savings, it's a non-registered mutual fund. If you buy a mutual fund inside your RSP plan, it is now registered. And what that means is the government provides certain benefits with an RSP that you don't get outside of that RSP. And the biggest one is that you're allowed to contribute 18% of your earned income up to a maximum. And this year we're in that range of $27,300 or something.
Yeah.
It's $27,350
or something.
Yeah. So what that means is if you do the math on that, you look at your maximum, you probably have to be earning about $145,000 a year or in that range for you to hit the maximum. So once again, 18% of earned income to the maximum. Someone that earns $50,000 a year is able to put 18%, or basically, what do we have, $9,000,
yeah.
Right? So $9,000 is your limit that you'd be allowed to. But here's the interesting thing. All the years that you've been filing the tax return, and my dad was big when I turned 16 and was starting to earn some of that money, even though I invested it poorly, earning that money. The issue is that he said you have to start doing a tax return so that you can start building your RSP contribution room. So even if you don't make an RSP contribution, that earned income, the 18% of earned income, you're building up that potential for the future. And that's a very, very important thing to remember. because when we start talking about RSP versus TFSA, Craig's got some great insights and planning strategies around why you might do one versus the other when you're younger. Okay?
Yeah.
So remember, if there are any questions, I'm watching the chat room. If something pops up or a Q&A, don't hesitate. Let's dive in here. Craig, next slide.
Okay.
So do we have a question, a poll question?
Oh, a poll question. Oh,
Not right.
we haven't got there yet because we got to explain the scenario, I think, Mark. Yeah.
Thank you. Okay, I'm sorry. I
No,
just thought we had
there
one that
is one.
says, yeah.
Oh, is there one? Oh, right. Okay, well, let's. I apologize.
Why we have three of us?
I had the
Why we
script.
have three of us?
I had the script and I biffed it. I'm sorry, everybody. So we'd like to know if you right now have an RRSP or an RPP through your employer. It's a sort of a similar concept.
And everyone should know what it is because Mark just explained it very well. So.
How are we doing?
We got 18 responses here, so I'll just publish.
Hey, look at that. That's great.
Yeah, a number of folks do, so that's great.
Yeah. And I appreciate the people that answered not knowing what it is. You might have just heard it for the first time when I explained it. So let's just give you a little difference and show you how it works from your money. And for those that were on the webinar yesterday, you learned about compound interest, about your money working for you. So here we are back to the twins. We'll close that off, sorry. So we've got Lisa, once again, remember, yesterday, Lisa started out saving early and Bart didn't. He waited till he was 35 before he started saving money. And we saw the power of compound interest. But now Bart's caught on a little bit and Bart says, he says, Lisa's pretty smart. I'm going to do what Lisa does. Lisa starts saving $100 a month in her RSP, but Bart just starts putting $100 a month in his bank away in a savings account. So now we go ahead and we go.
Oh, I think, Mark, maybe we can go down, like, do you want to talk about some of the benefits of an RSP as compared to not being an RSP?
Yeah.
Anyway, I don't, because if we want to basically have the scenario here to check it out as to who's going to be more, right? We're going to have the poll question in a moment. Yeah.
Great point. And sorry, Craig, for those of you that, once again, were on the call yesterday, we wrapped up with doing an income tax return. And one of the things on the income tax return that Craig told us was, how do you reduce your total income to get to a net income number, to get to a taxable income number? And one of the things he talked about was having a deduction, reducing that income. And that comes through a contribution to an RSP. So that's one of the big benefits. The government allows you that 18% of earned income to the maximum, whatever that amount is, they allow you to reduce that from the amount of income that you pay tax on. And then inside the RSP, that money grows from now till you're age 71, compounding and growing with no annual tax. And you don't have to start paying tax on it till age 71 when you start taking the money out in small increments. So those are the two big benefits. You get relief on how much tax you pay today, and you can grow it inside that registered vehicle. Remember, umbrella under whatever you invest in for all of those years. Anything to add, Craig?
No, I think that's perfect. I may have stepped on it a bit here, but let's launch the poll and see what people think about who's going to have a lot more money at age 65.
Right. So we just
explained. Yeah, we've got to remember that Lisa's money is growing tax-free, but then she'll pay tax on it when she takes it out, whereas Bart's leaving it in, and there's tax on it each year as he's earning the income.
Right on.
So I think people are caught on pretty good here. I'm very pleased with the poll results, so I'll just share it right now.
Awesome. You have, in the immortal words of once again, you've snatched the pebble from my hand. So there we go. 45 years later, I know it seems like a long time, and it's only $100 a month. Lisa has $197,000. They both had a 5% interest rate, but Lisa didn't have to pay any tax on that money until the end. Bart had to pay tax on his investment the money that he earned in investment, he had to pay the tax every year. So once again, his only compounded out at 3.25%, because if you took 5 less the 35% he had to pay, that's how he got to the 3.25%. So once again, compound interest is really important. Bart's doing a good thing by saving money, but Lisa did a better thing, that she saved money in a tax advantaged vehicle like an RSP. Okay? Good to go? Unless there are any questions?
I don't see any coming up in the chat.
Okay. So now we get to go to the next level. So Lisa, we're now going to talk about the difference between a retirement savings plan and a tax-free savings account. So the first clue on that should be tax-free. So what you have is they are both classified as registered vehicles. So you can only buy them when you have a social insurance number. The interesting thing is an RSP, if you have earned income and you're filing a tax return, you can purchase an RSP. Whether or not it's an advantage to do it at a young age is something that we're going to flesh out a little bit more and talk about. A tax-free savings account, actually, sorry, I just got to grab my little note page here. Tax, just for limits, tax-free savings account is exactly that, but you must be 18 years of age or older to buy a tax-free savings account. So if you had turned 18, but you have never contributed to one, based on the year that you turned 18, there is a maximum that you can contribute right now, and you can catch that up. So I'm just going to give you the numbers here. Tax-free savings accounts were created in 2009. So the limits changed every year. So from 2009 to 2012, so 9, 10, 11, 12, those 4 years, you were eligible to contribute $5,000 each year. In 2013 and 2014, it went to $5,500. So you had 20,000 plus another 11. We're at 31,000 now. So for anyone that was 18 in 09 and hasn't contributed. In 2015, it was 10,000. So now we're up to 41. In 2016, 17, and 18, it was 5,500. So there's another 16,500. So we're up to 57,500. And then in 2019 and 2020, it was 6,000 each year, which is another $12,000. So for someone who had turned 18 in 2009 and hasn't contributed, they could put $69,500 inside a tax-free savings account right now if they had the money. Depending on your age, you'd have to add up the limits. And it's quick. CRA, all you have to do is Google CRA TFSA limits, and the schedule comes up and shows you how much you can contribute each year. So, oh, sorry, we're getting a little feedback. I don't know if someone has to mute. No. So that's all right. Now, remember, tax-free means tax-free. You can put that money in, you can take that money out and put the money back in. There are some rules around when you can do that. You have to make sure you don't get into an over-contribution zone, because there is a penalty of 1% per month every month you're over-contributed. And here's what happens. People put in, if they're at the maximum, and that's when it happens, when you're at the maximum all the time. But people put money in and think it's like a savings account and then take money out. And then maybe they keep contributing, and then they contribute that lump sum back, and all of a sudden they have too much money in the tax-free savings account, and at the end of the year they get a little bill from Revenue Canada that says, well, you got to pay 1% per month because for these months you were over-contributed.
Yeah, it's a real rat's nest to get down that. So in general, a tax-free savings account, you want to withdraw once a year if you must, and you tend to, the clock resets as of January 1st of every year. So that's a really good point to make, Mark, for everyone to be aware of before they get into this. But maybe let's take a poll and see how many people have a tax-free savings account right now.
Right on.
That's interesting. We're about split compared
Okay.
to the RRSP.
Very
So
good.
a lot of more people have TFSAs than RSPs, which is interesting. That's
Mm-hmm.
great.
Well, let's do this. Let's look at the difference between Lisa and Bart, and then we're going to actually have Craig just share with us a little bit about one of the big questions we get all the time is, well, which one should I be doing?
Right.
Okay.
So in this scenario, we've got Lisa contributing $100 a month in her RSP, and then Bart's doing $100 a month in the TFSA. So let's just have I'm going to do a quick poll about who we think is going to have more money at the end of this whole it's age 65 year when they're doing this.
Is this a trick question, Craig?
Yeah, you're stepping on it. It's a trick question, but so basically, those of you that are looking at it and saying, "Well, shouldn't they have the same amount because they're both growing tax free?" You're right, and we're little scamps over here. We like to sort of play with everybody. So, in general, you're going to be consistently right. So,
yeah.
So they both grow with no tax, and but the big difference here that I like to highlight, and the Mark's highlighted it already a little bit, is RRSPs, you get a deduction from your income when you make the contribution, and therefore when you withdraw anything from an RRSP, it's taxable income at that time. It's sort of what goes up must come down, and the government always wants to get their tax at some point. Tax-free savings accounts, you make those contributions on after-tax dollars. So, you get your paycheck, there's deductions from it, and that's the money that you're making the tax-free savings account contribution. With an RPP or an RRSP, you're making that before any taxes come off. So there's a benefit in that that extra taxes that you're paying right now is going to be added to your RRSP that you can then grow it. But it is a big difference between how much money you're going to have at the end of it compared to RRSP versus versus TFSA. So in general, when you're younger in your life, you're going to have a lower level of income than at the end of your life. So Mark earlier was talking about impressing the young folks at the dealer finance at the car dealership for his Ford hybrid, and that's because Mark's a little bit further down the spectrum, and he's in his highest income earning years right now. And so if we're thinking about, maybe I'll throw it to the chat. So I don't know, I don't have the question framed right in my head, sorry everybody, but in general, you're going to want to make those RSP contributions later in life when you're earning higher rates of income, because you're getting a bigger bang for your buck with the marginal tax rate. As we saw yesterday, for those that were on the call, we have a 26% rate in that first bracket up to say around $45,000, and then it goes up to 33 and 40 and higher as you go. So if you're earning bigger dollars, then that deferral benefit of putting off the RSP of the RSP deduction, it puts off the taxes at a much higher rate till down the road. So in general, you're getting a bigger bang for your buck if you contribute to your RSP later on. And the good news, go ahead, Mark.
Sorry, Craig. Yeah, hold that thought, because so Craig, the point he's making is absolutely that discussion. And I know where we're going to in this, but when you think about it, if someone makes a $10,000 RSP contribution and their effective tax rate, Craig made the difference on that, marginal effective, but if you get over a top dollar, their effective rate is 45%, and they contribute 10,000, they technically get a $4,500 benefit, like to reduce their tax, their income, the tax.
Right.
A person in the low bracket with a 25% effective tax rate and contributes the same 10,000 is only getting about a $2,500 benefit from that. So Craig's point is, you're better off to be using that RSP when your tax bracket is higher than when it's too low, but that's not the only factor.
That's right. And one thing we have to keep in mind too is that, as Mark pointed out, tax-free savings account, we get a certain amount of room that we can contribute each year based on how old we are and when the program came into effect. As we take money out of the tax-free savings account, that room that can be recontributed in the future. That room limit doesn't get eroded. If the RSP contributions are limited to 18% of your income, but if we take money out of the RSP, it's just the room is gone forever. And so in general, if we put money in RSP, we want to leave it until we're retired. And in a TFSA, we have the ability to take it out and put it back in if we need to. So the one caveat to that, which I think we'll get into in a later slide, is the home buyer's plan a little bit. But essentially, that's where you can draw money from your RSP investments and contribute it to your first your home purchase, which is somewhat of an advantage. So as we compare the two and contrast them, in general, putting all your eggs in one basket is typically not what we'd recommend at Virtus Group, and diversification of investments is always something Mark's going to talk about. A blend is often a good bet, but in general, I would say that as a younger person, the TFSA makes a little bit more sense because you're more likely to maybe have need of that cash to be able to take it out, and you don't want to sort of shoot yourself in the foot and lose contribution room. And as well, your income's a little bit lower in general, so then you're getting more of a bang for the buck if you save your RSP contribution room into the future. Because the room you generate at age 16 or 17 or 18 will carry forward indefinitely. You don't lose it ever. You only lose it when you make the contributions. So there's no hard and fast rule on that, but in general, that's how I would sort of frame it for most people that I speak with.
So now that we did that, I think you should still do the poll question.
Oh, which poll question? Oh, yeah, I got the old one. Oh, dang it.
Let's see how many get this one right, though. This is another trick question, ladies and gentlemen. Another trick question.
We need a third option on these trick questions so we can give people a stopgap or a pressure release valve. I have the whole script here too. I've got it all in front of me and I'm ignoring it today. I got, it's a trap.
That's all right.
Sorry, everybody.
It's still meaningful. So
Yeah,
how do we do?
Thanks, Mark. We're at about half of people have responded there. So a lot of folks are saying, yeah, we like the TFSA right now. So what's the answer to any question you ever ask me, Mark?
The answer to every question that I ask Craig is, it's beautiful. It says, it depends.
That's right.
I've been doing it now with my kids. Of course, I mentioned yesterday, they're all in their mid to late 20s, and that's the answer I give them all the time. They ask me a question, and I say, well, it depends. And to Craig's point, it's the exact answer because it really depends on your situation. So really be careful. When someone's giving you advice based on their own situation, it doesn't mean their situation is just like yours. And that's why it's always good to talk through these things. If your default was, and remember, if you were in a position where you can save $10,000 a year, obviously your max in a TFSA this year is $6,000. You could put the other $4,000 in a TFSA if that was about savings. And I alluded to it yesterday. I mentioned it once today already. We look at savings in short-term, medium-term, and long-term dollars. Short-term dollars are what you need within this year. Either one of those products may not be the right thing. Using a savings account might be a better choice. Medium-term dollars, saving between 1 and 5 years, your TFSA is your best bet to max that out and do that. And then 5 years and beyond, definitely the RSP is going to win that one because it's about your long-term savings. So that's a better way to frame your savings approach than it is to make it product specific. Make your decision based on the facts and your time frame, your time horizon, then match the product. I was trained that way 36 years ago. Identify the needs, consider your budget, and then determine the product choice. So same thing goes with this. It doesn't become so much of an issue as right or wrong. It becomes more of a situation of what's most appropriate for when you need the money. Okay.
Perfect. And you can even take money out of out of the TFSA and put it right into your RSP down the road if you wanted to. So there's a sort of a hybrid method that you can use as well.
Yeah. And we are going to talk about one other option as well when it comes to your first home purchase and how your RSP might be beneficial to help you do that.
Right.
Okay, so let's jump in. Poll question.
Oh, we're at this age range, it's pretty consistently what I would expect right now. Okay, there we go.
Yeah.
All right.
Yeah, no, that's good.
That's very consistent.
You bet. So those of you that have it, this will be a nice little comment to give you a couple of quick comments about what you've done. Lots of times might be pretty basic. That's how people start. Those of you that don't have that, just bear with us through these next 8 or 10 minutes. Just remember, we're planting a seed here. These are things that you will have to consider sometime down the road. So I know it's always tough. One of the things my first sales manager taught me in the insurance business was, he said, buying things like doing estate planning things when you're very, very young and maybe don't have the situation yet, it's a character decision. Because if you're the person of character that knows you're going to need it, regardless, doing it at a young age still has lots of merit. It's like starting saving early, starting a TFSA early, starting an RSP early. All those things, you ultimately need them. And it has a lot to do with who you are, character around discipline. So just remember that. Let's roll there, Craig. Thanks. So here's a quick little chart. Everyone just remember this. I'm going to go through it fairly quickly. When a person passes away, we talked about it being your estate's asset. Everything you own when you pass away. So today, if you own a home and you own a car and you have some savings and you were to pass away and you're single, right? If you passed away and you do not have a will is the legal document that says, here's how I would like my assets to be distributed. If you do not have a will, you die what we call intestate. One word, intestate. Intestate means dying without a will. And there is something called the Intestate Succession Act that exists in every province. All issues around estate planning are governed by provincial legislation. So we have different rules in different provinces. If you are to move provinces, you were in Saskatchewan and you have all your planning done in Saskatchewan, and you move to Alberta or British Columbia, for example, and you are now going to make your home and stay there, you are best off to actually get all of that documentation redone in the province of residence, because there are different rules that apply to those things. It doesn't mean that your will isn't valid. It just means that it would be more applicable written in the language of that province based on their rules. So that's what it means. The Intestate Succession Act has a whole chart that says if you pass away and you're single, here's where it goes. If you pass away and you're married with no children, here's where it goes. If you pass away and have children, the government will decide how your assets are distributed. Most people say, well, I want to decide. So what you need is you need a will. But I'm going to start on the far right-hand side first. There are a number of strategies here to change one thing that people are always cognizant of. It's called probate. Probate is the court fee to just verify that that is your last will and testament. And the fee has to be paid to the courts before anything is distributed. In order to get around that and have an easy transition of assets, the strategies start at the right-hand side. There's something called a living trust or a family trust. That is a separate legal entity that people will create and move assets into so that it is totally owned and controlled by the trust. They don't own it personally anymore. Lots of high net worth families and clients will do that with planning strategies around businesses and whatnot. So it shows that if assets are in that family trust and a person passes away, it's governed by the trust. All of those proceeds will go directly to the beneficiaries of that trust. They will not be part of probate and that court fee. Next one, gifting assets before death. If anyone on the call has ever been gifted money from an aunt or a grandpa or a parent that says, hey, you know what, I'm just going to give everyone $1,000 at Christmas time, what people do is they begin to distribute assets that are tax paid, they've got cash, and instead of leaving it in their estate to be subject to probate and or more tax, they just give it away. So when you do that, it goes directly to the beneficiaries and there's no other issues to worry about. The third category are what we can classify as non-probatable assets. So all the assets that you have, if you have an RSP, you are asked to put down beneficiaries. If you own a tax-free savings account, you are asked to name beneficiaries. If you have life insurance with your employer, you are asked to list beneficiaries. If you have a pension plan with your employer, you are asked to list beneficiaries. If any of you on the call has any of those things and you haven't listed a beneficiary and it just says estate, because that's the default, it means you haven't done anything to protect it from probate, because if it's your estate, it goes to your estate and is subject to probate and maybe other taxation. So that's one of the big things that everyone should be well aware of. Don't let it go to the default. Go in check your RSP, your TFSA, your pension, your life insurance, and make sure that you've named a beneficiary, because then it will go directly to that beneficiary and it's not subject to tax. The last area, and oh, sorry, one more thing with non-probatable. If you own things joint with right of survivorship is the term. So in other words, my wife and I, we virtually own all of our house, all the assets outside of our RSPs and TFSAs and pensions, we own them jointly with right of survivorship, which means if one of us passes away, the survivor has the right to all of those assets. So it automatically transfers between spouses with no implications at all. Tax-free rollover, no probate. Hey, Dale, we just spoke money. Thank you, Dale. I've got a question. Dale just mentioned, and I'll actually get there. He says, a will is more than just about money. If you and your spouse were both killed in an accident, which side of the family would look after your children? Your needs to specify that. Absolutely. Excellent point. And we're going to talk about in the will, the one extra thing that you want to be writing about. You're absolutely right. We're just talking about the distribution here. I'm going to make a comment on that. So thank you, Dale. Appreciate the comment. Probatable assets. So the other thing is joint with right of survivorship. But remember, two business partners will often own a property, not joint right of survivorship. They will be tenants in common, which means, and there are some people out there who may own a house with a sibling. You both own a house together, you both live there, maybe you have people renting, but you will own it as tenants in common, which means if one of you passes away, your share of the house goes to your estate. It doesn't automatically move to the other person. And that creates a different environment. As I said, I'm going to hit the highlights on this stuff. You have to know some of these things, especially if you're going to begin to own property. Whatever's left, so anyone that has assets that are left to your estate, all of those assets are subject to probate. In Saskatchewan, our probate fee is pretty low.
Very reasonable, yeah.
Very reasonable. It's $7 per thousand. So if someone had $1 million of assets that were subject to probate, $7,000 has to go to the court, which basically leaves about $993 to be distributed. Might be a little bit that you have to pay the lawyers. Okay.
It can get up there on large estates though, Mark, where you'd rather not pay the government $21,000, $28,000, $35,000. Like it's a fee that's unnecessary in some cases. So if you can avoid it, you want to, for sure.
Absolutely, Craig. Remember, people we have clients that move from Saskatchewan to British Columbia. British Columbia, it's 1.5%. So it's $15, not $7,000 on $1 million. So very different from province to province. And the way your assets are distributed is one of two ways. Either outright, oftentimes between spouses, it says, if I'm to pass, everything is left to my spouse outright, no strings attached. But when you have children who are minors, oftentimes it's left through a testamentary trust. So for us, if my spouse and I are both gone, if I pass away, everything goes to Janice. When she passes, it's left to our children. They are entitled to receive so much at every age. They're going to get 25% at age 25. They're all over that age now. 25% at age 28, and the balance at age 30. And the reason that makes sense is because it protects them from themselves and it protects them from other people. In other words, the trustee that we would name is responsible to look after those funds on their behalf and distribute to them at those ages. And once again, what that helps them do is that they won't spend it all at a young age. Like at 21, they wouldn't have got it all. The trustee would pay for their care, maintenance, and education, but they get no capital until they're 25. But it also protects them from someone who maybe doesn't have the best intentions in getting together with them and trying to take the money that's theirs. If it's held in trust, any of our kids they don't own the money. The money's held by the trust. They're only entitled to what they receive. So let me make a quick comment. I understood that testamentary trusts were no longer available. Good question, Dale. Actually, testamentary trusts are. What has changed is the tax treatment of testamentary trusts.
That's right.
You have a 3-year window that they have to be wound up. Otherwise, the tax treatment on those, they were always treated on like a progressive tax rate like an individual, but that has changed. So great question. Craig, I don't know if you want to just.
Yeah, no, you don't get the personal exemption that first 13,000 or so, but you do get the graduated rate. So if you're only earning $40,000, it's all taxed at say 26%. Whereas now, after the 3-year rule, Mark, as you said, now they're all going to be taxed at 48%. So they're not gone. They just they've limited the lifespan on them. Because you used to be able to have them going for 20, 30 years, whatever you wanted to, or I guess 21 years at the time. So yeah, they're not gone, but they are limited in their use. Still very useful though.
Right on. Great. And I just want to make one comment. Dale made a great comment. So in the will, there's one other provision. Well, there's a number of provisions, but the one big provision that he mentioned is around guardianship. So once again, it's really important to appoint guardians for your children. So there's two important things here. When there's a couple, and if there were an accident and they were both to pass away, you have to make sure that you've named someone beyond the two of you to look after your children that aren't the age of majority yet. But a really, really important point is the trustee. So whoever you've named as that contingent executor or executrix, that is the person responsible for distributing the assets. So I'll give you an example. For Janice and I am her executor. She is my executrix if either one of us passes. If we both pass, we've named a good friend as the trustee who's responsible to invest and look after the money. When our children were under the age of majority, we had a different person as the guardians, a couple, her sister and husband. So in other words, they were responsible to look after the kids, but they had to go to our other friend for money for the kids. Because if you have the guardians and the trustees as the same person, oftentimes there may be a reason to say, we are all distraught. All of us have to go to Disney World for a couple of weeks just to get over the loss of your mom and dad. That stuff happens. So to Dale's point, guardianship in a will allows you to plan for some other things. All right.
Okay.
No other questions? Let's roll. Thanks for your attention on that one. Really important stuff.
So we got about 35 minutes left. We do have a lot of slides left to cover, but some of these are pretty quick, so I think we should be okay, Mark.
Yeah. So this is really a highlight on the 3 phases of life insurance. Life insurance, remember, as I said, at the most simple level, cash when needed. In that first phase of life from age 20 to 55, the number one reason people will carry life insurance is number one, income replacement. If they have responsibilities, they were to pass away, it can help replace their income to a certain amount until their children are at least post-secondary educated. The second reason they buy it is to eliminate any debt. If there's mortgage debt or business debt or something like that, or line of credit debt, if they pass away, typically people want to make sure that there's no debt and there's some income that continues on to their spouse and family. In phase 2, between 55 and 71, the number one reason people will have life insurance is what we call a bridge to retirement. Example, something happens to a spouse at age 55, but their plan was to retire at 65. They still have 10 more years to complete the retirement plan. So what happens is that the life insurance provides that little bridge. In other words, here's enough money to make sure you can complete the retirement plan, and then you go into retirement. The third phase of life insurance needs between 70 and 100, number one reason people consider strategies there is mostly around taxation. We live in a country where we talk about it all the time. RSP, defer. Capital gains, defer. Everything we can do, lots of our investments can be deferred until a later date. But when the second of us dies, between spouses, when the second one dies, most things are subject to tax at that time. So once again, there can be a huge tax impact and reduce an estate by as much as 30% or a third, 33% if you wish, depending on that. So people will look at insurance strategies to help offset the tax. That's it, Craig, on that one. Products, all I'm going to say on this one is there's 2 basic categories. There are variations of the second category. The first category is called term insurance. It pays if you die and only if you die, and you rent it for a term. Usually 10 years or 20 years are the 2 big terms today. There used to be term 5 and term 15, basically disappeared because of pricing. So that's the type of insurance that most people should be considering when they have a high need and a very low budget, which is like my daughter and her husband in their late 20s with 2 little girls under the age of 3. They've got a big need if something happens to one of them, but they don't have a big budget to spend it. So term insurance is a great strategy. Permanent insurance, we refer to as when insurance is something you own. It's insurance that has both insurance benefit and values. And it's, as I said before, it's not to get into this picture. There are some definite merits for it. It's one of those things people say, well, should I own permanent insurance? And the answer is it depends. And it depends on your circumstance and situation. Okay, Craig?
Perfect.
Works every time.
It depends. Yeah.
Once again, we just wanted to hit the highlights here. Anyone wants to flesh this out or has deeper questions, we're always happy to take that offline and answer it for you.
But in general, life insurance is going to be way cheaper the younger you are. So folks like Ashley gets a cheaper rate, and she's healthier than me, so she's also going to get a cheaper rate that way. So sometimes it's tough on your budget to be getting some of these insurances that are permanent when you're younger, but it will pay a lot of dividends down the road. So it's something to consider for everyone.
Yeah.
Thanks, Louisa.
Yep. Perfect. Living benefits. This is, flip the page here on this one, Craig. Thanks. So this is, once again, this chart, we'll send it out to you. It was never our intention to work this in detail, but life insurance is pretty straightforward, pretty easy to prove if someone's passed away. Certainly if they haven't. There are people that have gone missing. That's a whole other situation that insurance companies deal with. But living benefits are 3 products that you are party to the claim, which means you're still alive and claiming on it. There's disability, there's critical illness, and there's long-term care. And down the left-hand side, when you get this slide sent out, it talks about what it offers, how it works, and why you should consider it. So real simple, disability, it's something that if you're totally disabled, it will pay you a monthly amount all the way up to age 65, and then it's done. Critical illness is a product out there that typically pays 1 lump sum, and it has a list of illnesses that you may contract, 25 to 30 of them. If you survive 30 days from the diagnosis of one of those listed illnesses, you will get paid a lump sum tax-free amount. And the last product is long-term care. People will buy that. People who don't have a lot of savings will look to buy a product like that because they can afford the premium, but they can't afford to save a whole bunch of money in their later years. So what they will do is consider buying a product so that if they do have to get, if they are going into a long-term care facility, they will be reimbursed so much a day to help offset those costs. So those are just the highlights of those products. As I said, just to give you a little idea, that's what they mean. You'll get that chart. It'll give you more information.
Great. So now we're going to pop up a little poll. We've had a lot of discussion. So our, I guess lecturing perhaps would be a way to frame it, but let's have a little poll for everyone to see kind of what your situation is right now. Getting good quick uptake, so that's perfect. Okay. So we got the majority of folks today are either living with their parents or they're renting a place on their own. And there's a few of us that own a home, so they've already gone through some of this stuff. So you might be able to help and participate on our section a little bit more than others. So that'll be perfect. So on mortgages and real estate, one of the things we're going to do is go through a little mortgage calculator. And in general, the biggest investment most people are going to make is in their own house, right? So that the house that they're living in. And as Mark pointed out in the priority pyramid, it's at a different level in that priority pyramid than real estate investments. Real estate investments in that top section are more about speculation for return on investment. This is where you're going to live. It is a good part of your, let's call it your retirement perhaps, because it is a big investment or a lot of value in it, but it's a very different sort of decision point there. So the big points that Mark has framed for us here in terms of what we want to do is we want to know what we want in a mortgage and what we need. And let's start with needs first and then move up to wants, because the larger the numbers we are starting out with, the more costly it's going to be in the long run. So it's a good idea to get a little bit of a flavor for for different levels of payments, whether you want a fixed rate or a variable rate. And so, Mark, maybe can you comment on why you might like fixed rate versus a variable rate in the short, like say in the next 5 years, which would you prefer?
Yeah, you know what? It's a great question, Craig, because rates are always going up or down. Most people like a fixed rate. One of the biggest advantages is just for budgeting. They know exactly what they're going to pay for the next 5-year period. One of the things too is in terms of interest rate, in rising rates, some people say, I want to fix the rate for the next 5 years. The risk is always, what's the rate going to be 5 years from now? Other people like variable rates, and they'll say, well, I'll play the rate game. So in a time of decreasing rates, people like to go variable because the trend is every time they renew, the rate is dropping, dropping, dropping. We've had a period of decade here of very, very low rates. We thought 5 years ago they couldn't get any lower, and they went lower. So once again, budget is the big one, making sure you know what you're paying. In a time of interest rates, you know what you're paying, whatever it is 5 years from now. And when we show you the mortgage calculator, we'll show you why you want to be really dialed into how much money you're going to put down, how much you're going to mortgage, and how that rate's going to impact it.
Yeah. And we'll talk about, like, certainly we always have to be aware of the down payment that we're going to have on a mortgage. And we talk on the next slide about the different levels where we sort of save on this government guaranteed CMHC fund or insurance there. One thing you want to do before you house shop is get pre-approved for mortgage. That's crucial. And so, because then you know what your sort of upper limit of the budget is. I know when I was buying a house for the first time, actually, I'm still in the same house from 2004 when we bought it. So I was lucky enough to get in before the real big real estate boom in Regina. And at that time, they also offered 0% down payment. So I didn't even need a down payment to get into a house. But I was approved for up to, I think, 3 times my annual gross salary to buy a house. And so at that time, I was approved to buy a house for $180,000. And I could not afford a house for $180,000, knowing what my budget was. So it was a sort of a bit of a reality check to sort of say, how much would I really need for a house? So we want to sort of talk as well about some of the other costs involved in home ownership as well. Now, one way to sort of fund it a little bit, which we talked about or touched on when we're talking about RSPs, is this home buyer's plan. So home buyer's plan is available to you to draw funds up to $25,000 out of your RRSP. And it's not available on the tax-free savings account. So that's one of the differences between the two. But in general, this could be a way to sort of shield some income from tax and then still be able to use it for that down payment. But one key thing for that is if you use the home buyer's plan to purchase your house, you must do the repayment into the RSP over the next 15 years. So if we use, let's use $15,000 as the number because I don't really want to screw around with hard math. You saw that yesterday if you were on the call. So we'd have to repay at least $1,000 a year for 15 years to not have that RSP room go away if we used it up. So I see a lot of folks that will use the home buyer's plan to do a home purchase, and then they don't repay the RSP. It comes into their income each year, and they've lost that contribution, which is unfortunate. Not the end of the world, but just maybe not your best bet. So on CMHC fees, this is a kind of a big deal. If we're buying a house for $400,000, CMHC, it's Canadian Mortgage and Housing Corporation, and they guarantee mortgages in Canada. And it's like insurance, like any other product that Mark was talking about earlier, but they charge a certain rate based on how much of a down payment you are able to put down on your house. And so that down payment amount, the higher the down payment, the less risk it is, so the lower the fee there is. So you can see in the slide that we need to get at least 5%. And for higher dollar amount houses, of course, the first 500,000 is a certain amount, and then over that, it's another staggered amount. But in general, you want to get as much of a down payment together as you possibly can, because that's going to reduce these CMHC fees. They do just add it to the cost of your mortgage, so you don't necessarily see that up front. But if we're adding an extra $4,000 or $5,000 to the start of your mortgage, and it's over 25 years, that can take a long time for us to get it repaid. So there's other sort of a traditional mortgage. Some people will go to a mortgage broker. Some people will just it's important to have a good relationship with your bank always, right? Of course, Mark. But there's different ways that you can do it. Most people, though, are going to get a mortgage off the start because most people's first home is not one that they're building. And they normally don't have a bunch of investments they can borrow against to build the house. But these are sort of more mature people would be going for this. Mark, did you have any points you wanted to raise on the mortgage stuff before we go to the calculator?
That's awesome. You covered it. That's exactly, Craig. You covered everything. And yeah, let's get to the fun stuff.
Okay. So what we're going to do, oh, geez. This isn't as bad as last time, though, so don't worry, everybody. So I'm going to ask you for some chat feedback here right away. So what we're going to do is pull up a mortgage calculator to sort of show what things look like if we get a mortgage and sort of just illustrate some differences.
So yeah, so why don't we have someone who has a mortgage just give us a loan amount, the mortgage amount, and the interest rate you're paying, and how many years it's amortized over. If you could give us that, we'll use that as a starting example. If someone
just use
is
the
willing
chat
to share.
function. If you can put it to everybody so everyone can kind of see it as you go, that would be useful as well for us. Don't everyone rush. Ashley, we might have to bug you. No?
Okay. Let's throw one in there.
All right. So how much do we think we're going to pay for our first house? I think someone was in Calgary. Market prices are a little bit different there than Regina, but let's, someone please throw out a number for what you might want to pay for your first house here in Regina, for example.
I got my condo for 185.
All right.
185, smoking
Okay.
deal.
So how much is the mortgage?
140.
Ooh, good point. 140. Okay. So you made a $40,000 down payment on that, or $45,000 down payment, Ashley?
Yes.
Ooh,
nice.
1.4 million. Sorry.
I'm like, what?
So
Dream
do you
home,
know what interest rate are you paying, Ashley?
It's variable, and I think it's at around that 2.9 mark right now. Or no,
Okay.
yeah, no, let's just use 2.9. I think that's around where it is. Might be 2.7.
Sure. And
how many years is the amortization? Yeah.
30.
Yeah. 30?
30.
Okay.
There we go.
And how often do you make payments?
Twice a month or bi-weekly.
So 26 payments?
26 payments.
There we go.
So what we can see here in the top right, we can see sort of, we've got a $140,000 opening mortgage. That's the balance that Ashley has signed life on the line for with the bank. And over that 30-year term of the mortgage, she's going to pay $72,000 of interest for a total payments of $212,000. So you're basically paying almost half of the amount of your purchase price in interest, but that's over 30 years, and you're going to, hopefully your income rises as you go. So that's not the end of the world. So one thing we wanted to highlight here, though, is did they give you options in terms of how long you would amortize it then, Ashley, when you were going through with the bank?
Mm-hmm. And
you chose 30 because, let's spread it out a bit. Then there's always prepayment options, early options if you want and stuff. So there's no judgment here. We're in the trust tree and the nest.
And my income at the time I purchased it. So.
Yeah, now that she works at Virtus Group, she's at a much higher level of income. So that's good.
Right.
So let's have a look what would happen if Ashley was able to change this loan amortization to 25 years, which is a fairly standard amount of time. So it cuts us down by $15,000 over the life of the mortgage, which is that's a pretty hefty savings, Ashley. Are you motivated to cut down your payment term now?
Maybe a little bit, yeah.
A little bit. So let's see what would happen if how much do you think we'd save if we cut it down to 20 years of an amortization? What do you think, Ashley? How much more in savings?
Like the same, double, 15 maybe.
Okay. Another 13,000 in savings. Yeah. So every 5 years we're saving a fair amount of cash here. Mm-hmm. Now,
and look at the interest, how the interest dropped from 72,000 to 46,000 in over that decade.
10 years, yeah.
So let's go back to our starting point of a 30-year mortgage. And actually, you've mentioned that you're in a variable rate mortgage, which is pretty good right now because things have been working out very well with rates staying relatively low with prime and the way the interest rates are going. I think, Mark, anyone that says they know where interest rates are going is maybe optimistic, let's call it, because it's a very hard thing to predict. But let's say, Ashley, how much do you think your interest would go up over the life of your mortgage if your rate was up by 1% on average? What's your guess?
How much my what would go up?
How much total
interest paid?
Yeah.
I don't know. There's a reason I'm not an accountant.
All right. Well, I'll still let you off the hook. $28,000 for 1% more.
Yeah.
So that's, and then if we go up to 5%, it's a similar thing. It gets to be a little bit higher because we're not paying as much down on each payment term. So in general, we're looking at variable rates are great in terms of shorter term flexibility. And also you maybe have a little bit more options to prepay a mortgage. But just to illustrate that the more we can put down as a down payment, the better off we're going to be. The shorter the amortization term that we can do, the better we'll be. And if you can make more payments per year than less payments per year, then that's going to sort of keep that, it's going to chip away quicker so that your interest is slightly reduced. So this calculator is a little bit too simple to illustrate that, but if you can get a weekly payment on your mortgage, that's actually better than doing monthly, because you're just making payments quicker, so the interest accumulates a little bit slower for you. Is there any other comments or questions? Go ahead, Mark. Sorry.
Actually, Craig, could you just go back, put it back to 3% interest? Okay, and leave it at 30, and just go to number of payments, go 12. So 12 payments there, that's paying monthly, right? And then go to 26, so you'll just see that.
Yeah, the calculation's a little too simplistic, so it doesn't actually do it
and
properly.
then go to 50, go to 52.
I don't think it's going to change it, because a little bit. Okay, that's a little bit better. Yeah.
So anyway, those are the highlights. Craig's point, like I said, the more you can put down for a down payment and even save on the CMHC fees, the number of years to amortize, the fewer the years, you're going to be better off. And the more payments you can make, the better off you're going to be. And the thing to focus on, these calculators are available online everywhere. The thing about that is to just pay attention to how much total interest that you are paying out when you think about that cost. And there is a trade-off to it, but you have to think about how most people don't focus on that number, but it's a lot of money.
Okay, we'll go back to the presentation. We got another 17 minutes. This is normally the part where we can go a little bit quicker, I think, Mark.
Yep. No poll question?
Oh, wait, was there a poll question? Sorry.
Yeah. And Dale, yes, it's after-tax dollars. You got it. That's a great point. People have to learn that at a young age. No poll question?
Oh, I don't know what my poll question was now. Okay. I was going to do if you're still awake. I'm not doing the it's still awake check. It undermines the legitimacy of your presentation, Mark. I don't want to do that.
You got it.
Sorry.
Right on. Okay, well, let's hit the investment piece here. When we look at investing money, one of the things, these are going to, 2 seconds. Benefits of working from home. Good. So when we're talking about investing money, we talk about having an investment discipline. And investment discipline starts with asset allocation. So there are three main categories that we have. We have cash, we have fixed income, and we have equity. Those are three broad-based categories. It certainly gets beyond that, but it matches to allocation is based on, objectives. Is your primary objective preserving your capital? So making sure that nest egg that you have doesn't shrink. Is it growth? Is it providing income? So there are a number of things that you have to be looking at or considering, and you also have to consider time horizon. So this goes back to what I talked about before. Short-term investing, medium-term, long-term. Short-term is less than a year, medium-term is 1 to 5 years, long-term is 5 years and beyond. So when you look at the first category of cash, there are things that you can invest in. There are things out there called high interest savings accounts that aren't so high interest. They pay 0.5% is what they're paying on a basis. So they pay 0.5% really on an annualized basis. There are cashable GICs. Those are called guaranteed investment certificates, or often referred to as term deposits. They can be cashable, meaning after 30 days you can cash them in with no penalty, or you have them set, which we've actually categorized under fixed income. So I'll talk a little bit about that now. Once again, for cash, time horizon is 12 months or less. So what you are well served to do is if you need money in the short term within the next 12 years for a specific thing, people will say, well, I set aside money to pay my income tax. You can't mess around with that money. You have to be able to pay your tax with it. Other people will say, I'm saving money for 6 months because I want to take a vacation. Well, you want to make sure the money's there. You don't want to have it going up and down and happen to be down when you need your money for a vacation. I'm saving money to buy a new television set or a new furniture or whatnot. That type of money, you're best off just to use a very liquid option, cash, investment savings, or something like that. Fixed income is a way to invest, as it says. That fixed income means it's a category that will typically have no volatility, be guaranteed, or have lower volatility. In other words, volatility means how much up or down you experience over a period of time, like 12 months, 24 months, or beyond that. So laddered GICs, when we use that term, guaranteed investment certificates or term deposits, we use a 5-year option. You can invest money and have a guaranteed rate of return if you invest for 1, 2, 3, 4, or 5 years. Here's the crazy thing today. You can lock up your money guaranteed. Your principal's guaranteed. It's going to be there. If you put $1,000 away, at the end of the year, the $1,000 will be there. But the best rate you're going to get out there, we have 30 different providers there. The best rate you're going to get is 0.7% today. To lock up your money for 5 years, the best rate we can find is 1.75%. So you can have preservation of your capital. You can guarantee your capital will always be there, but the rate of return that you're going to earn on your money isn't going to be that great. Next thing, bonds. All levels of government and corporations issue bonds for money that they need in for their operations. So when a corporation like a bank, or there's lots of them out there, issues a bond, they will typically pay you a higher rate than a guaranteed investment certificate because there is some volatility on that money. It can go up or down, but it doesn't tend to bounce a whole lot. Once again, we've seen crazy things happen over these years, and the rating is important. Triple B is what we call investment grade or higher. So in other words, Government of Canada issues a bond, it's AAA rated. A corporation like maybe Ford Credit could issue a bond that's triple B. It's still investment grade, but the difference, it goes literally AAA, AA, A, and then there's pluses or minuses. Then it goes to triple B, double B, B, and it goes from there. So once again, the better the credit rating, the lower the return typically. And then something called preferred shares. I'm going to leave it at that. It's a totally, it gets into a totally different realm. Remember, the highlights of this, the presentation here was for highlights. Under equities, now what this means is you're buying equities or stock in a company. Something, I'll use an example, Royal Bank. You could buy 1 share of Royal Bank today for about $101. That's what it is trading at right now. If you buy that, you're buying that share that in anticipation that that share will be worth more than $101 in the long term. 5 years or more, lots of people buy stocks with a 2-year horizon. And I'm talking about investing money. I'm not talking about trading. Because there are people that trade stocks that are looking for small gains and they'll trade in and out way quicker. We look at long-term investing. But in addition to your desire for growth on that Royal Bank share, does your principal or the amount you originally invest guaranteed to be returned if you invest? So Ali just asked the question, does your principal or the amount you originally invest guaranteed to be returned if you invest, sorry?
In a bond, yeah.
In a
Are
bond.
bonds, is your principal guaranteed in a bond, Mark?
Well, the thing is technically it isn't, but the bond does have a maturity period. So it is to mature at that, as long as that corporation that issued it is still there. Governments, typically they are. So you are going to get your principal back plus the interest. But for me to say they're actually guaranteed, I can't say that unless it was actually guaranteed. Great question. So on the equity side, people are also buying Royal Bank because Royal Bank is a mature business and they're still reinvesting in their business, but most of their excess cash is available to pay dividends. And that's why people will buy bank stocks, because Royal Bank will pay you a 4.5% dividend. So they pay you 4.5%, whatever you invested every year, and you're also hoping that your Royal Bank share goes from $101 to more. But let's put it into perspective. Royal Bank was trading at $109 back in February. In March, when everything hit with COVID, it traded down at $72. It's now back to 101. But that's that volatility we talked about. It dropped from 109 to 72, pays the dividend every quarter all the way along. But once again, people have to understand that they have to hang on to it for some value to recover. If they would have sold that, if they would have bought that stock at $100 and sold it at 72, they would have lost $28 per share on their investment. So those are the things. Equity investing, it's fluctuating constantly throughout the day when you're buying stocks. It's all about time horizon. And then the last category I'm going to put on top is investing internationally or outside of Canada, in the US, in other countries. And there are all kinds of products that you can do that with. You don't have to buy individual stocks. You can buy a mutual fund, which is taking mutual funds. There are 2,000-3,000 mutual funds out there, and they're across all of these asset categories. You can buy a mutual fund that is only bonds, only Canadian equities, only US equities, only international equities. You can buy a mutual fund that's a balanced fund. It has a little bit of each category. You can buy, like, once again, you talk about asset allocation, any category, any mix, you can find a mutual fund to do that. So the nice thing about a mutual fund, it is a diversified way to invest, and you don't have to buy, you don't have to build all the pieces. And we have clients that invest in different ways. Some use a mutual fund mandate, some want us to build a portfolio for them. So that's the concept of investment discipline. Once again, I know there may be some frustration out there with this, but there's no such thing as sitting through a session and figuring out how to do investment. We've often talked about going into deeper dive and only focusing on the investing things and educating people on all that stuff. Remember what our purpose was here today, to introduce you to these things, to let you know about how important it is to get going, but you do need to find some guidance with someone that's going to help you do that. Okay? Once again, 3 things you always want to talk about. What are your objectives? What are your income needs? And what's your planning horizon? So for example, if your objective is long-term growth, you have no current income needs, and your planning horizon is beyond 10 years, you will typically look to maybe invest a little more aggressively in things that have a greater potential to grow. But once again, it depends on risk aversion. We have some clients that buy nothing but GICs because they can handle zero volatility. We call it your sleep at night factor. If you can't sleep at night because your investments are going up or down, then there's lots of things that you shouldn't be buying. But the greed, the human nature in us, we want all the opportunity for growth, and we want to take on no risk. Another important discussion is tax. It's over to you, Craig.
Yeah, so I'll touch on it very quickly, but in general, interest expenses to a company, they get to deduct that fully. So they get a deduction, so that's fully income in your hands. And so as comparison to dividends, dividends are coming out of a company after they've already paid a layer of corporate tax. And so you as an individual have a little bit lower tax rate on dividends than you do with interest. Capital gains, currently the inclusion rate on a capital gain is only half taxable. So if you bought something for $100 and you sell it for $200, your gain, or $100 of that, only $50 is taxable to you. And that's sort of policy-wise, is just that it incentivizes you to invest in things that have a little bit of risk to them, and for the long run, and to hold it that way, sort of keep the economy going in that general nature of it. So in general, one good tip is that if you have a tax-free shelf, like a tax-free registered portfolio through a TFSA or an RRSP, that's not a bad spot to hold interest, because interest in your hands personally in a non-registered investment is going to come with a little bit of a higher tax burden than dividends would, and same with capital gains. So one thing we've seen recently with some of the markets being down is clients are asking us, should we hold some home run swing investments in our TFSA versus our RRSP? In general, it's still just like, who knows? But TFSA, because when those funds are withdrawn, there's no taxes on them, there can be an advantage to holding those types of investments in the TFSA versus an RRSP. But in general, like anything else, if you earn income, you're going to pay tax on it. Just the nature here is, there's some information on the slide that we'll be sending out to you at the end, so I don't want to touch on it too deeply today.
Right on. We only have three more slides or so. So
yeah.
let's do pools of capital. So here's a nice quick little picture to show you this concept of what type of investments and just the treatment on income or the treatment at the end of time on the estate value. Left-hand side, you have 2 pools. Pool one, is a pension pool, which is registered with the government, and pool 2 is your RSP. The reason they're segregated is because that's for retirement money. And it just gives a nice little concept about what we're talking about. Pensions are either employer-sponsored or government-sponsored, things called Canada Pension Plan or Old Age Security. And then what happens to your income. So when you take income from either your RSP or your pension, all the income you take is fully taxable. From an estate value, meaning at the end when the person passes away, a pension will only continue to a survivor. Beyond that, it doesn't continue on to children. An RSP, on the other hand, is controlled by you. It wasn't, it's not, once again, it's controlled by the fact that you had it, and it can go to your spouse. But even after spouse, after taxes paid, there can be an estate value that will go to children. Tax-free savings account, tax-free means tax-free. Got contributions, tax-free withdrawals. Withdrawals create more deposit room, totally tax-free on estate value. Option, you can roll it to a spouse to continue. We've had people that have passed. So instead of having 100,000 in a tax-free savings account, the spouse now has 200,000 because you can roll it and consolidate it and keep on going. Non-registered is what Craig was talking about. This is investing money outside of any registered vehicle. It's not in a pension. It's not in an RSP. It's not in a TFSA. It's just an investment account. And now that concept of taxation on either interest, dividends, or capital gains is really, really important. Capital gains, you can defer, and at the bottom you say, remember what I said before, after the second spouse dies, no, once again, it can continue on, but all the tax has to be paid. And the last thing, there's something called tax-exempt insurance. It's not for this discussion, but that's where we talk about insurance, permanent insurance that has values. It's treated totally different.
Right.
Next slide.
This is my favorite slide of either day. I love this slide.
So here we go. This is what you have to know about investing for the long term, and people get caught in this. This repeats itself all the time. This just talks, it just shows from 1998 to December 2018. For someone investing had $10,000 invested at the end of 1998, what happens? People have a herd mentality. The market starts going up. People are saying, I want to get in. And typically they might buy at the very peak. And then things start to drop off and people said, I'm out, it's never again. And this is the roller coaster ride that people go on. They buy and sell and they're trying to do it. And once again, if you look at it, it goes from $10,000 to $36,000 for someone who actually bought and sold at the wrong time, and how the market went up in between. But if you're the next person and all you did is start and invest and just stick to your discipline, do we have that page?
I don't, is this one marked?
No,
I don't think we do have the page of.
Oh, well then that's totally destroyed it. But if you look at it, the person from 1998 to December 18, if they stuck to it, their rate of return on that would be like 3 times that. Because once again, they didn't care about what was going on. They stuck to the long-term discipline. But once again, investing money for short-term, medium-term, and long-term is what you always want to be doing. Throughout your life, you're always going to have money needs to do those things. So you always have to be very, very aware of what's your time horizon. Can you live through the ups and downs over time? Next slide is a little busy. You'll get that one. That just does the same thing. It just talks about this concept of all the different things that had happened to create changes in the market. And the next one.
This one I like too. It's very colorful, very colorful.
Very colorful. So here's the idea of why you want to have diversification in the way you're invested. We talked about having cash. We talked about having Canadian equities or US or international. If you look at these, it shows the different types of investments. And if you just look at the colors, is the same color at the top all the time? And the reality is no. Certainly real estate, the red block, had some pretty good runs over those periods of times. But if you look at what happened in 2016 or 2017, up and down, and then in 2020, if you invested only in real estate trust investments, once again, you would have a fair bit of volatility. So because we don't know which area in the world is going to be, which asset class is the most popular, what you have to always have is a nice diversification of the different classes. and making sure that for investment advisors, shifting from one to the next has some merit, but you oftentimes can't totally leave a particular asset class because you never know what's going to happen. So people that hold only cash, you see across the bottom, cash tends to be along the bottom all the time. Yet in 2018, cash was the best place to be.
If only you had a crystal ball, right, Mark? Yeah.
Only had crystal ball. Ours is always out at the cleaners. We never have it around us to pick on. So in closing, 5 financial lessons for young adults. These are big ones. Save for a rainy day. Doesn't mean you have to have the cash sitting doing nothing, but you want to make sure you have a plan. Number 2 is demonstrate your work ethic. Once again, you have to learn early and have some good discipline. Number 3, understand budgets. Once again, we did budgeting yesterday. You saw the impact. Like trying to step out of university and earn a $72,000 a year job, which didn't give you any savings. That was the exercise we went through yesterday. And number 4, compound interest. The power of compound interest. Have your money working for you. And number 5, be careful with credit. Do not get in that trap. Pay your card off every month. If you're not paying it off every month, you are not in a good spot. That's just going to spell danger down the road. I've seen it far too often. I experienced it as a young guy. And as I said, I used the line yesterday. A good buddy of mine always said they print new money every day. He wasn't worried about how much he had on his credit card because he figured he could just get more.
He'll dig his way out. That's right. Yeah.
He'll dig his way out. Yeah. Anyway.
So, thanks very much, Mark, for all the wisdom you dropped on us today. That was it's a dense presentation, but this is my favorite of the 2 sessions just because of the level of discussion we can have. Unfortunately, we didn't have as much back and forth today as maybe yesterday was, aside from the polls. But now we'd like to open it up to, of course, we're at our time. But if anyone has any questions they'd like to ask us, you got a very wise group of 3 here. If you have any questions, please feel free to bombard us. We're also going to have that. The survey for the feedback on the day coming up automatically as well. So please, through the chat function, if you have any questions you'd like to ask on anything today or otherwise, please let us know right now. This is the only thing between you guys and I guess the rest of your evening. So we'll wait and see if we get any. We're not going to give you too much time here. But,
and just, Craig, as people are maybe formulating a question, just a reminder that, you know what, if someone wants to reach out after, through Craig or Ashley, we're always happy to jump on a call and answer a question in more detail for you.
For sure. Yeah, 100%.
Thank you, Jillian.
Yeah.
And I'll email the slides and the mortgage calculator out tomorrow.
Good.
Apple and Tesla stock splits, Mark. Ooh, what a meaty question.
They are. I'll just quick question. Once again, remember stock splits real quick. Stock splits allow more people to participate. Like I said, if you want an A share of Berkshire Hathaway, it's $300,000 for 1 share, but the B share trades around $120. So once again, stock splits are always good to allow more people to participate, and that's oftentimes why businesses will split stocks. You watch bank stocks often get to over $100, and they'll split back 2 for 1 for $50 because it allows more people to participate. So that's just a quick comment on that.
And Mark, is that part of it is that similar to the housing market, if the house is $300,000, a lot of people can buy a $300,000 house. Not everyone can afford to buy $1 million house. So there might be a little bit more value attributable to $300,000 might stay at a higher price than otherwise because there's a larger pool of people that will be willing to buy. Is that part of the mentality behind it?
Absolutely. Like I said, just more people being able to own it, like especially Tesla, where I haven't watched it lately. I mean, it was through $900 and beyond. And I mean, that's what they want. They want more people to be able to invest. Yeah.
So Mark's guaranteeing Tesla will increase in value, I think is what I heard after the split, is what he's saying. Yeah. There are no guarantees. That just caveat.
Death and taxes. Those are the guarantees in life,
That's
right?
Right. Yeah.
Right on.
That's true.
All right. Are there any other questions from anybody?
Doesn't look like
I'm not seeing any. So thanks everyone for your time today. Again, as Mark said, any questions, just please send them to us offline, and we'll be stopping the presentation now, I think. And And then you
feedback.
get that survey for the feedback, which we really, really value
please.
and appreciate. So thanks everyone. Yeah. And thanks everyone for your participation today. I love the poll set. It's just so much fun. So thanks again, Mark. Thanks, Ashley. And have
Thanks,
a great
everyone.
evening, everybody.
Yeah.
Bye-bye.